Hi everyone, good morning. My name is Deepak Bisht, and previously we have done the investment banking question and answers. Now this is a new series where we will be discussing the key concepts. And today is the session one. It's the episode one of the key concepts, and we will be starting with valuation basics, where we have discussed about. Okay, today we are going to discuss about these are the valuation basics, and we have previously used these basic elements in the form of questions, what we are trying to find. Now let's try to understand each concept more clearly so that when we revisit what we have done previously, so we would be able to make a better sense. So let's get started. Uh, so valuation basics, episode one. Okay. So here we are going to start with the enterprise value. And then we will talk about equity value, the valuations, the types of valuation and all, discounted cash flows, and the other elements which I have indexed here. So there is going to be 13 topics which we are going to cover in the valuation basics. And the first topic is enterprise value. So what actually is an enterprise value? And today we are going to discuss about that only. So enterprise value is actually if you want to buy the entire business of, entire business of any company tomorrow only, or within a few days, within a few months, if you are planning to buy a business, then what would it really cost you? And that is what enterprise value actually means. So enterprise value is actually the cost of whole business. And by the definition, it's one of the most important concept in corporate finance and valuations. It actually represents the total value of the company's operating assets. Of the operating assets. And I'm emphasizing on the operating assets here because it's important and just to understand what's operating assets are and non-operating assets. And we will discuss about those in a while. The total value of the company's operating assets, the value of the entire business, as if you are buying all of it, including its debt obligations. And this is also important, all the debt obligations. If you're buying something, you're buying it whole. You're not buying not buying it in parts. So companies all operating assets, and it also includes the debt obligations, and of course it also includes the non-operating assets also. But these two things, I am emphasizing on these two things. So this question, this are these three questions. So first question we have answered, what is an enterprise value? So we have discussed about enterprise value. So this is pretty much it. So if you're going to buy the company, how much you will pay for the company? Okay, so after that, the formula for enterprise value, what is the formula for enterprise value? If I am going to calculate the enterprise value and how I'm going to calculate the enterprise value, always ask questions why. Why this and how? Why and how? If you're talking about anything, always ask why. Why, why, and why. This why and how. So this actually helps you to dig deep into the concept. Why and how. So how do I first, so why, what is enterprise and also what? So what is enterprise value? If I'm going to buy a business, this much I am going to pay. So that's enterprise value. And how I'm going to calculate the enterprise value. So enterprise value is pretty much calculated. Okay, so understand this thing. how it's enterprise value calculated. I just told you that I'm going to buy the whole business. I'm going to buy the whole business. This means that I actually have to pay. Who do I have to pay? I have to pay the equity shareholders. I'm buying the company. I will be uh, paying off to the equity shareholders, to the debt shareholders, to the preferred share equity shareholders, right? And minority shareholders, minority interest, cash and cash equivalent. I'll be using cash and cash equivalent to pay off these things. So let's discuss about what is equity value. So equity value is nothing but the current market value of the share. Either it's in dollars, either it's in rupees, euro, yen, whatsoever, wheresoever the company is being traded. The currency, the dollar amount of the stock today, the share price, and I will multiply this with the total number of fully diluted shares. Fully diluted shares. Remember this thing, diluted shares. I'm not going to multiply it with the basic shares. Not basic shares, but the diluted number of shares. That's why diluted number of shares are important. So not basic, but diluted number of shares. So this is how we are calculating it. The share price, the current share price, and the fully diluted shares. So the basic shares. And after that, what we are going to do is we are going to okay, before that, before going to the debt part, let's understand. Okay, just give me a moment. Now it's comfortable for me also to write it down on the tablet. Okay, so the total debt, we are going to talk about total debt in a while. But before, what are the things that we need to consider when we're talking about the fully diluted number of shares? And we need to consider when we are talking about fully diluted shares, we need to consider the stocks, stock options. We need to consider the restricted stock options. And we also need to consider the convertible securities because these are going to dilute our number of shares in future or if the stock is in the money or out of the money. So to understand this thing, the fully diluted shares, we need to do a different session on in the money or out of the money topic to understand the diluted number of shares. Okay, so let me just clear it out and then we will talk about the debt securities. Just remember the formula that it is about the current price of the stock. So the current share price and we multiply it with the fully diluted shares and the fully diluted shares includes stock options. It includes restricted stocks, RSU, restricted stock units, and it also includes convertible securities. Okay, so I hope this is clear. And let's talk about debt. So this total debt actually includes long-term debt and the short-term debt. But the short-term debt is actually to be paid within 1 year, and this actually includes the this these are small short-term securities which can include bank line of credit, commercial paper, and short-term loans. And the long-term securities actually include bonds. It includes bonds, bank loans, and it includes notes payable, which have a life of more than 1 year. So this actually have a life of more than 1 year. Okay. This actually security has life more than 1 year, and these securities actually have a life of less than 1 year. Basically, what I'm going to do is I'm going to subtract my short-term securities. I'll actually pay my short-term securities, and I'll only carry forward my long-term debt. I will pay off my short-term debt, and long-term debt I cannot pay because this is long-term in nature, and this cannot be paid immediately. Okay, so I think this explains it. Uh, Now understand this thing about preferred equity. What is preferred equity and why it's included in the company's structure? So preferred equity is actually something which is somewhat behaves like debt. It is also considered like debt only. It behaves like that. It's not that, but it behaves like that. This behaves like that. This means that uh, these securities actually the name itself tells something about the security only. So preferred security actually there are fixed dividends in the. I mean, whosoever is actually holding the preferred equity, they will be getting a fixed dividend, and they also have a priority over common shareholders. So priority over common shareholders. So that's pretty much how a debt also behaves like. So preferred equity is also behave. It actually also behaves like debt. And uh, for a real life example, Bank of America has a. I mean, Bank of America has preferred shares that pays set dividends, and uh, or any company who actually have. If you are holding preferred shares of any company, then those preferred equity stocks are going to pay you fixed dividends. And during the time of dilution also, those preferred equity, you will also have a priority over common stockholders, uh, in whatsoever is left after selling of the assets. But preferred equity, as the name is equity, the preference will be given to the debt holders first. So preference will be given to the debt holders first during the time of dilution. And let's talk about the minority interest. So minority interest is non-controlling interest, and when a company owns more than 50% of any company, so here it's more than 50%. It's more than 50% of a company, not but less than 100%. So it's in between a range of 50% to 100%, not 100%. Then this is considered as a minority interest or non-controlling interest. So the parent must report 100% of its subsidiaries revenue and profit, and it does not fully, I mean, but does not actually, you do not have to own it. So, but they actually have to report the 100% of the subsidiaries revenue and profit. Like if you are aware about the company Rivian, which is actually into electric cars, just like Tesla. So Rivian, Amazon holds 18% of Rivian. So there is no consolidation in the income statement. But if Amazon would have hold 60%, then it would consider and it would consolidate Rivian and then report a minority interest for the part of for those parts which he do not own. So you add minority interest, so the enterprise value matches the consolidated earnings being valued. So we add back minority interest also. And cash and cash equivalent. We subtract cash and cash equivalent to calculate the rest of the following. Okay. And now understand where is enterprise value used? So enterprise value actually reflects the value of the business independent of its capital structure. So capital structure, whether it has preferred equity, whether it has these full diluted stock options, these are, I mean, if company has dilutive securities, preferred stocks, preferred security, and other kind of debts, which are going to dilute the number of shares, then it's considered as uh, I mean, it's the capital structure. Actually, this actually, or everything is a part of capital structure. Capital structure basically means that what type of securities they have raised, the type of securities they have raised to fund the company. So if the company has previously raised stock options, raised money through stock options, restricted stock options, and convertible debt, or with preferred equity, then it's all a part of their capital structure. So capital structure basically means, in simple terms, whether using these capital structure, will my basic number of shares will be, is there going to be any change in my basic number of shares, or are they going to be diluted? So that's for that, you actually have to understand the company's capital structure. And the key intuition here is that the enterprise value is enterprise value reflects the value of the business independent of capital structure, and equity value is actually what shareholders own. So this is actually equity value. So equity value is what shareholders own, and enterprise value is actually what the business is worth to all capital providers. So enterprise value actually considers all capital providers. So it includes all the debt providers plus equity holders, debt and equity holders. Okay, so let's do some practice questions, simple practice questions. Uh, and one more thing I would like to add here is that enterprise value is used in various multiples, valuation multiples. It's used in valuation multiples. And without enterprise value, your valuation, it's difficult to calculate. Uh, it's difficult to value a business. Uh, and if you come across any multiple which is preferred by investors, you will always see enterprise value multiples, enterprise to EBITDA value. You will see these are very common multiples, enterprise to EBIT or enterprise to revenue. So these multiples, so this is where enterprise value is actually used. In merger and in acquisitions, enterprise value actually indicates what the buyer pays for the acquired company's operations. And in merger and acquisitions, in DC, M&As, in DCF, in relative valuation, and and etc. So enterprise value, you actually have to calculate enterprise value. So let's discuss questions. Uh, I have actually prepared 10 questions from I mean easy. The initially they were easy and the level of difficulty increases as we goes down. So it's easy to difficult. And let me just remove everything here first. Okay. So we can do a little better. We can use a little uh, more space for our calculations to do. Okay. So let's talk about the definition of enterprise value. So enterprise value, we have discussed about what an enterprise value represents in corporate finance. So enterprise value represents the total value of the total value of the company, but company's operating assets only, which is actually available to all capital providers, which those are debt holders and equity holders. And its theoretical takeover price for buying the entire business. So that's enterprise value. It represents in corporate finance. The components of enterprise value. The components of enterprise value, yes. Debt is the component of enterprise value. Market cap is the component of enterprise value. Private equity is the component of enterprise value. But cash is not a component of enterprise value because we actually use cash. So we subtract cash. That's why cash is not a component of enterprise value. When you are calculating the business, you are not including that somebody actually. So, okay. So if you are acquiring a business which actually have thousand on the balance sheet, they have $1 million, $1 million on their balance sheet. So if you're acquiring the business, this actually is your $1 million now. So if you're buying the business for $10 million, then you can use this $1 million to pay the $10 million, and then you will only have to pay $9 billion. So this you will actually subtract. So cash is not a component of uh, enterprise value. So the formula for enterprise value is market cap plus debt plus preferred equity, and we subtract the cash out of all this. I hope this was clear. And let's calculate enterprise value, and let's do a simple example. So enterprise value, if I have to calculate enterprise value here, so it's simply market cap. We will add the market cap, we will add the debt, and we will subtract the cash. So we'll subtract the cash, we will add the debt, and the market cap is here. So it's 120 minus 10, it's 110. So this is the simple calculation of enterprise value. And when we add multiple components into enterprise value, so enterprise value multiple using multiple components is market cap is 400. Market cap is the share price into the fully diluted shares. And remember this thing, market cap is share price into fully diluted share price. Never say it's only number of shares, share price into number of shares. It's fully diluted number of shares. So market cap, we add the total debt into it. We add the preferred stock and we will subtract the cash. So this will give us four, uh, 550, 570, then we subtract 50. Okay, it's 25. So this will give us $525 million. Next question is whether it's true or false. Enterprise value is greater than market cap. Can it be? Can enterprise value be greater than market cap? And the answer is it's false because a company with low or no debt or a lot of cash can only have an enterprise value which is less than market cap, and this is a rare case. So it's not always greater than market cap. The question here is saying always greater than. No, it's false, but in some cases it could be true. So if the company has low or no debt, or it has a lot of cash, in those cases only it will be true. And just remember, anything is possible, but not always. The question is explicitly asking you whether it's always greater than market cap or not. So understand the question first. Low or no debt, lot of cash. If there is low or no debt, now understand this thing. If there is no debt, this, okay, let me just go to the formula. If there is no debt, I mean, this is, we are going to scratch it off. And there is a lot of cash. Now understand this thing. If the market cap of the company is 100, a preferred equity, I'm also assuming it's not there. Minority interest is not there. And there's a lot of cash. I'm saying 500 is the cash. So enterprise value is going to be, or even not 500. Let's assume it's 110 only. If it's 110, so in this case, enterprise value is going to be greater than market cap in this kind of case. So no debt or low debt or a lot of cash. So in that case only it will be true, but generally it will be false. Why is cash subtracted in the formula for enterprise value? Now let's understand this thing. Because cash is actually a non-operational asset. It's a non-operating asset. Cash is actually a non-operating. And when we are actually buying the business, we are only considering the operating asset. That's why I actually, in the starting of the video, I actually emphasized on the operating assets and the debt obligations. So operating asset, operating assets only. So we are subtracting because this is a non-operating asset. So cash, it actually reduces the net cost to acquire the company. And if you buy a company, you get the cash also. So you can effectively pay less for the operating business. And this actually does make sense because cash is a non-operating asset. Just remember operating and non-operating assets asset. And if when the concept is that you pay less when you are using the cash. So it actually is it reduces the net cost to acquire the company also. So that's why we are actually subtracting the cash, and that is why cash is not a component when we are calculating the enterprise value. Okay, the next question is, what is the difference between enterprise value and the equity value? So a company has a market cap of 500 and an enterprise value of 800. Explain the difference, indicate how the company's about the explain what this difference indicate about the company's capital structure. Okay. So enterprise value is actually the market cap plus the debt plus the preferred equity plus the minority interest, and we subtract the cash. So enterprise, if the enterprise value is 800 and the market cap of the company is 500, this means the difference is coming from these part: debt, preferred equity, and then preferred equity, minority interest, and cash. The 300 difference is coming from there, and the company is likely to have debt, a preferred equity, minority interest, and relative to which it actually has cash which they have used, and that's how they so if they have high of these and they have paid off some portion of this using cash, so this indicates a leveraged capital structure. So this actually indicates a leveraged capital structure, which means leverage in itself means debt. It is, so you have actually raised money. This is, and using debt, preferred equity, minority interest, you have invested somewhere. You own more than 50%, but less than 100% of some company. So, and you have subtracted the cash to pay off some of the portions. And this is what actually is causing this difference between the market cap and the enterprise value of the company. So understand this thing. This technically, in financial terms, it's called leveraged capital structure. Leveraged capital structure. Okay, so I hope this is clear. So let's move to question number 8. So question number 8 is about the consolidation and minority interest. So consolidation and minority interest. Consolidation and minority interest, when if we own a company which is less than 50, more than 50%, less than 100%, we actually consolidate those revenue, those companies' financial into our company's financial, and we report the minority interest in the income statement. That's consolidation. And if the market cap is $1 billion, debt is $300 million, minority interest is 100, and cash is 250. If we subtract, if we calculate this, it will come out to be 150. And why have we added the minority interest? Because, see, understand this thing, because the parent consolidates 100% of the subsidiary's financials in its income statement, including EBITDA. And to match the numerator with the denominator, which is EBITDA minor in formula like enterprise value to EBITDA, so minority interest is added. So both reflect the same level of ownership also. So this will actually help us to calculate the ratios like enterprise value to EBITDA. Understand this thing. So you have added the company's financials into your financials. So the parent company has actually consolidated. So parent has consolidated 100% of subsidiaries financials into their company. And this actually includes EBITDA also. So if you are calculate, if the parent company has actually included into the EBITDA, so you also actually need to calculate, adjust the enterprise value formula for this also. So if there is minority interest, understand this thing. Why we are doing this thing? I own a company A and I have 50% more than I have 60% ownership of company B. So what I will do as a parent company, I will add the income statement of B into mine only. So I will add IS of A and I will add IS of B. So I will also add everything into my financials. So that's why companies report parent companies financials and standalone financials parent and standalone. Standalone and a parent, there is difference in financials. So these are some technical terms which I'm pushing in. Leverage buyout, leverage capital structure, standalone and parent. So now the parent has actually consolidated. So this means if you are aware of the components of the income statement, so revenue, they have added the revenue of B also with them. They have added the COGS also with them of B also. And further on, EBITDA also. EBITDA of A plus EBITDA of B. So to calculate this formula, so you need to understand whether you are looking at the standalone part or the parent part. If you are looking at the parent part, you actually have to adjust the enterprise value formula. If you're looking at the standalone point only, then you will actually have to subtract this component, this much component from the parent companies, and then you actually have to prepare a standalone income statement, and it's very difficult because at times companies do not report these numbers. So when you are looking at the you are looking to value a parent or a standalone, you need to first decide what you are actually okay. So what you are you need to understand what are you doing, and you need to take the relevant data for that only. So if you are valuing a parent company, then you actually need to consider this, and you will adjust your enterprise value formula. If you're looking at the standalone point only, a standalone standalone company only, uh, the standalone portion of the company, then you actually will have to subtract everything. So then this data is very difficult to acquire or obtain. This can be because, see, private or public, because of private or public, if the company is public, they do report out these numbers to the SEC or the uh, government authorities. But private companies do not have any obligations to report out their financials to the general public. The public companies report out their financials so that the general public, because the general public is also the equity holder of the public company, which is listed on the stock exchange. But private companies do not have any obligation, and this data, to acquire this data, it's very difficult. Okay, I hope this is enough to understand. And when we will do the other topics, we will get a better understanding of all these things also. And there's a lot of mess here. But I think this was required to understand the in-depth analysis of this question. So, okay, so I think we have answered this thing.